Thank you, everyone, for joining us this week on our regular speaker series. I'm very happy to be joined today with Jonathan Curtis from Franklin Templeton and Reid Menge from BlackRock here with us today. So if we can start, maybe Jonathan, let's start with you. Give us a little bit of background of what you do at Franklin Templeton and the fund that you manage.
Yeah, great. Thank you, and thank you for having us. So I have three roles at Franklin. First and foremost, I'm the lead portfolio manager on the Franklin Technology Fund. It's about a $9 billion fund focused on this big opportunity around digital transformation, and then we've identified 10 supporting themes under that across stuff I'm certain your clients will be very familiar with: AI, cloud computing, et cetera. And then, so that's job one. Job two is I lead the technology team in the Franklin Equity Group as part of Franklin Templeton. So all the analysts covering various parts of tech are on my team. And then finally, I'm an analyst myself, so I cover infrastructure software, IT hardware, the supply chain names. So that makes me the lead analyst on names like Microsoft and Apple and Cisco and et cetera. So, and then prior to Franklin, I was an engineer. I've been in tech either as a software developer or engineer or investor for 30 years now.
Great. Thank you, Jonathan. Appreciate that. Reid?
Yeah, thank you for having me as well. So I am the co-portfolio manager on the global technology funds here at BlackRock, about $23 billion of assets under management. I've been at BlackRock for almost 9 years now, about 20 years in the industry. I'm also the director of research for the technology analysts, do public in addition to private investing. So the private investments that BlackRock does in the tech sector, co-lead that as well. And happy to be with you today to talk about the tech sector.
Great, thank you. And for those of you who are not aware, of both Jonathan and Reid's funds are part of our focused growth fund. So these are strategies that we're pretty well familiar with. So we thought it'd be an opportune time to bring them here so some of you can hear more directly from the horse's mouth what they're doing in the current environment that we're in. So Jonathan, let's start with you. And actually, before we do that, I'd like to remind everyone, if you do have questions, please submit them to us via the chat. We're going to be talking for about 20 minutes, and then we'll reserve the final 10 minutes for questions from the field. So please submit them via the chat or to me directly. Jonathan, let's start here back up again with you. Obviously, we know it's been a difficult environment for growth, for tech, really since November of last year, right? It was really that CPI print in November that really sort of kind of reshaped Fed funds futures curve and expectations for monetary policy. How has your strategy done given the difficult environment for growth in tech? What are you doing, and what do you see yourself doing in the future to kind of help blunt some of the effects that are coming from the increase in the discount rate, which is obviously affecting multiples in the space?
Yeah, that's exactly, you've described it perfectly. That's exactly what happened. And I'm an engineer by training, so I love models and formulas and you can basically explain almost all of the decline in the index we use in our portfolio with the rise in the risk-free rate and in CAPM. Now, in our strategy, we have underperformed our index and underperformed our peers a bit for two reasons. One, we are overweight these, what I call them, sort of cash in the future businesses, companies that are investing aggressively in their futures and are growing at a good clip. We're also overweight companies that tend to be smaller and mid-size. And the two concerns there, one is the cost of capital is going higher. I think investors have been using really one screen through this process. Are you generating cash or not? If you're not generating cash, you get thrown out. And then two, they've been worried about these small and mid-cap companies' ability to navigate what could be a more difficult macro environment. On the first point, we're quite comfortable investing in companies with this cash consuming profile because really three reasons. These companies are well capitalized, and I mean with 5, 10, 15, sometimes years of cash flow on their balance sheets. Two, they are leaders in their markets, so they can use periods like this to take market share. And three, their business models are working, as evidenced by very good unit economics. So we pay a lot of attention to how much are you spending to secure a stream of cash flow? How long do you keep that cash flow for? et cetera. And then, I can give you numerous examples in the portfolio, but because investors have been throwing these names out indiscriminately, we've been selectively adding to some of those names. On the smaller and mid-cap side of things, it's hard to deny that a smaller and mid-cap business may struggle more in a recession, but not to argue that they won't struggle more in a recession. But I think investors are going to be surprised at the relative resilience of these companies. I think this last earnings season was some evidence of that. These are particularly on the software side of things, which is our biggest allocation and our biggest overweight. These models are very hard to turn negative. Even when bookings slow or maybe even go negative, if churn for these businesses is low, these companies are probably going to continue to grow. They'll grow at a slower pace, but they're going to continue to grow. So I think when investors see that resilience, they're going to reward it with higher multiples. So what have we been doing? We've used the past 7 or 8 months to go through our investment approach, which I was always looking at the quality of businesses, growth of businesses, and the valuations. The quality and growth potential of the businesses haven't changed, which changes the valuation. So we've used this period of time to improve the quality of the portfolio, double down on some names. And as the recovery now appears to have started, we're starting to outperform nicely again. So right. I'll stop there.
Excellent. Thank you for that. Appreciate that. Reid, any sort of thoughts or things you'd like to add to the sort of view of where we have been and kind of how you're positioned and what you've been doing, given the difficult environment?
Yeah, sure. So I think Jonathan nailed it. This is an environment where rates are dictating stock returns, and tech industry fundamentals are exceptional. And so, we have a low turnover strategy. We've not been doing much because at this point, we're 3 months likely ahead of when the rate hikes stop, and the market's pricing in potential cuts first half of next year. So if this has been about rates and inflation, we're getting kind of towards the middle part of this tightening cycle. And, absent industry demand falling apart, which we don't see, as Jonathan also alluded to, hard to make many changes. You just have to assume that the market is going to return kind of once this fascination with inflation and interest rates subsides back to the healthiest sector of the global economy, which is global technology. And so the urge to sell high growth tech and try to hide out in value, I think would be the wrong approach, because value tech, these are companies that are the losers. That's the definition of why they trade at value. The world's passed them by, and there's newer companies with better mousetraps that are growing quicker, that we're confident once the market stops worrying about inflation, interest rates, and we're getting towards the end of that cycle, they'll go back to thinking about fundamentals, which are very strong right now.
Okay. Let's talk about this framework, and I don't want to keep it all in terms of a macro discussion, because I know both of you are at your cores bottom up stock pickers. So I'm more the top down guy, but I will keep a couple more questions in that space, because one framework that we've been using is historical valuations for growth and value. Historically, and you can take my word for it, you can look it up later if you want to fact check me, but historically growth tends to trade around 55% premium over value. Like Reid mentioned, with good reason. They're better companies usually, right? That premium got up to as high as 130%. So it got, we're talking about 2 standard deviations above that. It's come down 94. What do you say to people that, okay, well, it's still, it's lower than what it was, but it's still historically expensive versus value? What's your reply there? And maybe I'll go with Jonathan so that we can just keep the round robin on this.
Yeah. So, I think that COVID was an incredible proving ground for the power of technology companies. Mm-hmm. And ultimately COVID was the antidote until we actually had an antidote or a vaccine. Firms like Franklin had to really get into their own usage of technology to survive, stay relevant, build deeper relationships with our customers. And I think now in the reopening phase, certainly firms like Franklin, but other firms in other parts of the economy are doing the same thing. They are operationalizing what they learned about during COVID, and they're extending it. So the reason that discrepancy exists, I think, is because people understand that we are in a period of sustainable growth potential. Also, the sector, and I'd love to hear Reid's views on this, but the sector has also improved dramatically over the past 10 years, 10, 12 years. It's become much more profitable, dominated by much more recurring revenue sources. There's real platform businesses in here. So it isn't the tech sector of 15, 20 years ago that was dominated by semis and PCs and less predictable sources of revenue where there were commoditization forces. There's these massive platform businesses that are sitting on top now of this awareness of the power of technology that I don't think really existed broadly in enterprises until COVID came along.
Yeah, that's exactly right. I was going to lead with this. Structurally, the industry is just very different. Technology really, there's really two cornerstones: it's semiconductors and software. The rest of it are just basic applications of these two technologies. And if you think about really those two cornerstones of the industry, the semi industry has massively consolidated over the past decade. And in fact, probably very few know this, but the semiconductor industry is the most profitable sector within, I'd argue, almost the world. You're looking at companies with 60, 70% margins. And these are oligopolies in many situations. And so 5-10 years ago, there was lots of companies and there was a big consolidation wave. And so there's just massive pricing power, fewer vendors. VCs did not flood semiconductors with excess capital. There's just fewer companies in the year 2022. So just fundamentally healthier businesses. They should trade at higher multiples than they did back in 2015. And software is the same thing. Software is as Jonathan alluded to, it's gone through this transition to SaaS, which just means higher recurring revenue, greater visibility. And you ask yourself, why do companies like Procter & Gamble trade at such big multiples? It's because investors know they're going to grow a certain rate. That's why they're willing to pay so much for them. That's kind of what's happening to software, where the world went from a license model of we have no idea what we're going to sell and license this quarter to now we've got 95% visibility into the year 2023, sitting here in August of 22. And so you should pay more for that. And so I think those are the two reasons. And I also agree with Jonathan's point about, spending is absolutely accelerated post-COVID, and that's going to continue for the next few years. So it's the combination of just better demand environment on a multi-year basis, coupled with just better structural health of these industries.
I would also add, we spoke a little bit at the beginning of the call, so I know some of Reid's background. As these businesses have transitioned to software as a service, they're now running your workloads for you. That puts these companies in the pole position to watch what you are doing with the software and allows them to more quickly come back and add value and get insight out of it. So the whole value creation equation for a software company has changed. It hasn't just gone from license to recurring. It's gone from license to recurring to insight, which really wasn't there previously.
Right. Yeah, those are all very salient points. One final comment on the macro side, and then we'll go into your actual portfolios and where you see value. Jonathan mentioned, obviously, that almost entirely, especially in your space, the contraction has been on the multiple side. It's been an issue with the discount rate going up. At what point, but you also mentioned, Jonathan, that the companies have adequate funding. Let's play devil's advocate here. Don't know if you have visibility on this, but let's go. At what point does the cost of capital go up so much that there's trouble in the space in these, let's say, smaller mid-cap companies that you own? So basically, what I'm trying to ask you is, at what point do you think the Fed funds would have to get to for it to really be a problem for some of these companies?
Yeah.
And you could
so
yeah.
So really, it's first is the duration of a recession and how long this capital is going to be expensive. So every quarter I look at the amount of cash these companies have on the balance sheet. I don't just look at it in absolute terms. I look at it as a function of their amount of their burn. Most of the companies we own are generating cash. Thank you very much. But the ones that are consuming it, we get very curious about how long they're going to need it. And if they've got cash for 5+ years, like that's much longer than any duration of a recession. Mm-hmm. And so I think they're going to be just fine. I think it's these businesses that are still private, not later stage, earlier stage, who have to keep returning to the capital markets and to keep the thing working until they kind of figure out how the model is working. And I think they're going to struggle. And I don't feel like, certainly we invest in later stage privates I suspect the BlackRock guys do as well. I think those guys are going to be fine. It's going to be the earlier stage private companies that are going to really struggle and have not reset their understanding of what they're worth. And so I think there's going to be pain there.
Okay.
By the way, the earlier stage companies struggling is a positive for public companies that are trying to compete with these vendors, whether it's on price or some new technology. It's a really since 2009. This has been 13 years of free capital and just so many startups and unicorns you read about, and those are the ones that are going after these public companies. The inability to fund those companies in the year 22, 23 potentially is going to be nothing but positive for those big public tech companies.
I have been wondering a bit about, I'd love to hear Reid's view on this, but we have been, certainly in my investing career, my professional career, in an environment of largely accommodative central banks. That hasn't been just through COVID, it's been on 20 plus years. And through that, marginal businesses got founded. And so I have been wondering, what just structurally higher cost of capital environment might look like. What will that mean for funding these marginal businesses? But I mean, boy, I'd rather be a business that has capital, has a business model that's working, can run consolidation, and as Reid pointed out, take market share. And that's the very definition of many of these public companies that certainly we traffic in.
Yeah. Reid, would you care to share some thoughts on that, or you echo those sentiments as well?
No, I completely agree. I think this is one of the things that's very apparent, and Jonathan's office is right in the heart of Silicon Valley. There's just not that many good engineers out there. That's just the reality. There's a chronic shortage. The extent to which small private companies can entice the best engineering talent to work for them, that makes the larger companies less competitive. And I began to hear rumors about a year or two ago that if you're a truly talented engineer, it's become embarrassing to work at a Google or a Facebook, because those are seen as essentially yesterday's companies, and you want to take your shot at that really hot startup. The extent to which this is a nuclear winter for funding, or you just don't get the funding anymore to create these businesses, it's going to make the industry, frankly, at least the public companies, healthier because they be able to retain talent. The big brand tech names that you all know, those have become to some extent lifestyle jobs, meaning you're not going to go to a Cisco and shoot the lights out, but it's a good job, good paying job, but that hurts Cisco's competitiveness. So I think a changing in the funding environment in tech, the changing the VC capital, just kind of flooding this industry is really going to help these larger businesses retain talent, make them more competitive. And it's going to help with public returns, because what's been happening since the year 2015, or really 2010, is you've got a lot of these private companies were accruing all their value in the private markets. And so companies like Uber, the growth of Uber was really benefiting the private investors, not the public company investors. And so the extent to which this kind of the private markets slow down, talent is retained at the bigger public companies. I think it's going to be a positive for public tech returns over the next 5-10 years.
So you think, so that's curious. So that's an interesting point. So you think that the more difficult fund, let's say the environment of systemically higher rates with higher cost of capital is going to be to the benefit of the larger companies in retaining talent, because it's going to be that much more difficult for startups to get going and to be able to pay these software engineers what they have to get paid in order to move from Google and Apple and these companies. That's an interesting point.
Yeah, we're already hearing it. I mean, talking to CEOs, they say, employees that in the year 2020 were quitting, our best guys and women are coming back in the year 20 because they got mortgages and and they've got a certainty of a job. Think about the security industry, like Palo Alto Networks. There are thousands of startup security companies that are trying to get the same employees. And the extent to which, if you're a truly talented engineer, you want to make sure you've got a job a year from now, and you're not at a company that can't raise a fund or can't raise funding, you're going to potentially stay at these larger companies. So yeah, I think it's gonna be a big help.
Excellent. All right, great. So this is a good segue into I'm sure what you both are going to want to talk about, which is your portfolios, right? So let's assume that we are entering a different, let's say a period of structurally higher rates. that, by the way, that's a view that we share from the macro side. We think that's a multi-year period. How are you positioning for that, if that's the case, or push back against me if you think, no, we're still in this, 1983 to 2020 period where rates are going to be systemically low or heading lower. So maybe tell us a little bit about how your portfolio is constructed today and how you see it evolving over the next few months and years. Jonathan?
Yeah. So, I mean, we definitely stuck to our knitting around the big theme of digital transformation and those 10 supporting sub-themes. But we absolutely have, taken this opportunity of reduced valuations to improve the overall quality profile of the portfolio. So that has happened. But I don't, like, thematically, I don't feel like I need to go elsewhere. I'm not changing the types of sectors I want to invest in. I just, if I can buy a higher quality business at a lower price, I'm going to do that. And that's largely what we've done. I don't think I would add. I've also, we've been pretty active in the private space, and with the reset of public valuations, I haven't felt the need to invest in as many private companies over the past 7-8 months, because I've got all this embarrassment of riches in the public markets now that are liquid.
Right.
So we've been focusing there.
Okay, Reid, how does the portfolio look now, and how do you expect it to evolve over the next couple of months and years?
Yeah, I think it's just been a big change. It's been more of a focus on those two cornerstones of tech I mentioned, software and semis, where I think as a tech manager, there's so many areas that you can put money. There's internet, and there's payments and hardware. There's so many different places to put capital. But I think what this environment is showing us right now, that this downturn is in higher cost of capital, is that a lot of these businesses are just not very good businesses. And so areas like fintech, like internet, I think there's just areas of the global technology landscape that are just less attractive going forward. They've had a great decade, but I think you realize companies with truly competitive differentiation comes down to code, it comes down to silicon, and then all these kind of applications of technology. Whether there's 1,000 fintech companies trying to give you a digital wallet right now. What's the differentiation? Same thing with e-commerce. I mean, it's basically, at this point, e-commerce is growing slower than brick and mortar. And so I think, the changes that we've made, I would say it's kind of moving more into really core technologies, deep technologies, and less so application of technology type of vendors. And then, tactically, being worried about things like recession is going to be bad for internet companies, big ad platforms, seeing opportunities in places like China right now. China was an area that, we're global tech investors. So a few years ago, that was 15-20% of the portfolios, and that got down to about 1% 18 months ago with what was happening in the region. And now we're looking at China again, because China, in many respects, is a year ahead of the U.S., where they're actually being accommodated at the central policy level. They're actually, the regulations are starting to go away. The regulatory cycle is loosening, and then you've got just the overall this bifurcation of the supply chains, which started back in the Trump era of the East and the West, creating separate supply chains, creating a lot of really good opportunities for companies in China. So those have been the biggest changes. We've moved about 15% of the portfolio, I would say, to more of that core type of stock. So kind of a lower growth, lower value type of name, but not much more than that, because we're confident that, as I kind of alluded to earlier, we're kind of getting towards the end of this rate hike cycle. And I think the market is certainly, as it gets more worried about growth next year, is going to look more to growth companies to ride this period out. And so you can't abandon the great franchises in the tech space right now.
Great. I'm going to ask you both one more question, and I'll start with Reid before I head to questions from the field. You mentioned, and I'll start with Reid with this, but Jonathan, please feel free to jump in if you have some thoughts to share as well. You mentioned semis as a space that you concentrate in, and I'm curious, how do you see the dynamics with especially with the semis and the foundries, let's say, occurring now with the CHIPS Act in the United States? Companies, there seems to be a global movement to, right, the moving, especially some of the foundries outside of Taiwan, given all the potential conflict in the area. We're seeing, we're hearing things of building foundries in Mexico and Arizona and some other places. We know though that the Chinese have been trying to do that for the last 20 years and it hasn't worked, right? Scale matters with the big foundries and stuff. How is this? How are you analyzing this, and how are you looking at opportunities in this space? I'm very curious to hear your thoughts on this as someone who's focused squarely in this space. And finally, if you could add with do you think the CHIPS Act is going to have a meaningful impact on chip manufacturing in the United States?
Start with that last point, and it definitely will. What's interesting with this industry now is you basically had just a few big buyers of semi-cap equipment over the past couple decades, and now, yes, you're going to have more factories getting built. That's at the end of the day going to be a lot more tools that get sold to these semi-cap equipment companies. China was kind of the original alternate buyer over the past, let's say, 5 years as they started to try to build out their indigenous industry. But yeah, factories being built in Arizona and Mexico, the diversification of the buyers, I think for semi-cap equipment in particular, it's going to be a very strong demand driver. It's going to be a big positive.
And certainly we have really good exposure to semi-cap equipment companies. I guess it's not just sort of owning real estate and building the fab. You need to know how to operate it. And there's a lot of know-how at TSMC, and that is going to have to get exported into these places where these foundries are being built. The Chinese have proven that it is very hard to cold start. And so, we own TSMC in the portfolio because I think they're going to play a role in educating these foundries that are being built in places in the U.S. on how to do things. So they're going to be able to still capture value. Yes, I acknowledge.
That's interesting. So you think that TSMC, Taiwan Semiconductors, for those of you who don't know, is going to actually be through joint ventures with some of these?
They're going to have to work this out, but ultimately there's a lot of know-how and experience there. It's not just buying the equipment. You got to know how to operate it and have processes, and they have figured out how to run a lot of SKUs and also work at the leading nodes. Intel is very good at running a few SKUs and high volume, and so ultimately those learnings that TSMC has going to have to get exported, which means they're going to be part of the process.
Yeah, let's see. I mean, not to sort of be droll about it, but let's see if China expedites that process by continuing to ramp up the pressure in the region. That might, right? I mean, that's going to create incentives for them to diversify as well, right? Because TSMC could exist outside of the foundries that it has right now in Taiwan, right?
Correct. And I mean, listen, I'm not a geopolitical analyst, but I think China understands that there's tremendous risk for them if they go after that asset.
Oh, it's been one of the reasons why we've actually been pretty sanguine on this whole, is China about to invade Taiwan? We think, just personally, I'll share this with both of you, we think that the flipping point or the inflection point will be when either country can secure enough chips themselves. That's when conflict becomes more likely, I think. But right now they both can't, right? So they need to keep it going, right? They need to keep the lights on there. So yeah.
Right.
All right, great. So I'm going to go to some questions here from the field. I'm going to venture to say I know how both of you are going to answer this, but is it a good time to start buying growth again? Let's start with you, Reid. And why?
Yeah, I do, because I would get concerned if these tech returns we're seeing year to date were due to fundamentals. That's very different than due to a higher discount rate. So what's the source of the weakness? It's inflation, it's interest rates, and so where are we in that process? We've hit peak inflation, starting to come down. It's still very high, of course, but the direction is down. And I think as the economy starts to slow, I think not just technology investors, but general investors that can go anywhere start to worry about their energy holdings and their industrial holdings because of a potential recession. And so therefore I want to look at secular growth. And so I think just the combination of we've hit peak inflation, most likely December is the last hike, potentially a cut next year, fundamentals still remain healthy. It's a good time.
And I would agree with that. And if you look at like across the 11 sectors of the S&P 500, I mean, tech and comm services, which where we spend a lot of our time, have been 2 of the 3 worst performers. It's got some of the best balance sheets, it's got some of the best profitability, and it's got, on a growth adjusted basis, tech's right in the middle of the pack and comm services is at the bottom. That setup all says goodness, in addition to everything that Reid just highlighted. Now, I don't think we're done with numbers cuts in tech. I think we probably have another quarter or so to go, a fundamental slowing a bit, but I don't think it's going to be a disaster by any means, because these models, again, particularly on the software side of things, are just incredibly resilient.
Excellent, great. I think we have time for one more question because we are running up against time. We're slightly over. So this will be the final question. What do you think is going to happen with stock buybacks within this particular growth tech sector? Let's start with Reid and we'll finish off with Jonathan.
No, it's a really interesting question because it's the exact question we've been asking executives. And I sense that there is actually some discipline on this topic. Companies that we talk to are guiding to maybe 2% dilution with stock comp going forward. There is a very high worry about talent and how do you retain talent. But it goes back to what I said before. There's just fewer companies that are getting funded, that look viable. And so if I am the CEO of you name the tech company and I have fewer competitors to worry about, fewer places that my employees can go, I can just pay you less because there's no place for you to be. So I think stock comp, which had gotten out of control, some companies, it was 40, 50% of revenue the past few years. I think that's going to start to come down. And CFOs seem to get it. I think boards seem to get it. And then just structurally, the way this funding environment's going to play out in the next 2 years, it's going to, you'll be able to pay employees less and retain them.
Well, we've been trying to be pretty vocal about with our companies of not resetting option pools and the like. You know, I'm trying to remind them that they're in a very good position for many of the same reasons that Reid highlights. Other than offsetting dilution, I'm not a huge fan of stock buybacks. I want these are innovation companies. I want them to be investing in their futures and not finding themselves like an IBM that, you know, deployed everything to a lot of their free cash flow to stock buybacks and ultimately doesn't have much to show for it. And now is poorly positioned for these big themes that are coming ahead. So, we're not huge fans of stock buyback other than offsetting dilution.
Great. Well, thank you. Well, unfortunately, we run out of time. It's been a fascinating discussion. So I'd like to thank both of you for joining us. I know this is perhaps rather unusual for both of you to be sitting down with one another, but like we mentioned, we hold both strategies and another strategy that we manage here. And excuse me, and obviously both funds are heavily held by advisors here at the firm. So I'm sure they all appreciated hearing your thoughts and your views on your portfolios and on the sector.
Great. Well, thank you for having me.
Thank you for joining us. And thank you all for joining as well. We'll see you next week on next week's speaker series. Thank you all. Have a great week.